Hi, I'm Charlie Jamieson from CIO at Jamieson Bonds. And this is hopefully the first in a number of monthly videos that we would like to produce to talk about the markets over the course of the previous month, talk about how our portfolio has performed and some of the roles that we believe a defend and protect assets such as government bonds can play for investors in the jigsaw of portfolio construction. November was a very challenging month for a lot of asset classes again, following on from a very volatile and difficult October in Australian markets. Throughout this episode, government bonds performed very well and played that negative correlation role which we've come to expect in times of difficulty. But I guess we've got to talk to some of the reasons as to why markets are experiencing this indigestion and suffering with this volatility. We believe a lot of this has got to do with the fact that the Democrats have taken control of the House in the United States and split Congress, thereby slowing President Trump's fiscal rampage, which had really been running the US economy very hot, but importantly, providing a big tailwind to corporate credit because of the excess cash flow that corporates were receiving as a result of the tax cuts. We expect that Trump will no longer be able to go on a fiscal rampage and start a second stimulus program now that the Democrats are very unlikely to support such a passage of legislation. This brings us to a more normalised credit environment in the cycle after we've already raised risk-free government interest rates in terms of the Federal Reserve rate and affected the value of US government bonds by raising interest rates over the preceding few years. But it's corporate credit spreads that have been very sticky at a very expensive level that ordinarily would have started widening by now. I think without this additional tailwind of tax cut cash flow behind the corporates, the markets has become very concerned about the tightness of corporate credit and the ability for that to be a sustained outcome, particularly in an environment where we've already got leading parts of the US economy such as housing and autos in fairly rapid decline. With the Federal Reserve telegraphing additional rate hikes into 2019, the markets are starting to get quite concerned that we are getting ahead of ourselves and we could potentially over-tighten, thereby forcing a US recession into the back end of next year or 2020, which is very popular with most economists. The other thing that's very concerning about corporate credit is they do face a huge maturity wall, i.e. debt obligations are coming up to be refinanced, and that requires the markets to not only be very fluid but very receptive and able to lend. And clearly, whilst we're going through some credit delinquency and some inabilities for people to pay in the same fashion that they have previously because of those higher interest rates, the markets are again getting concerned. So it's certainly something to watch very closely because those credit spreads have been a wonderful lead indicator to the performance of other risk markets. If we think back to July 2007, corporate credit spreads started to underperform very quickly. Equity markets went on to make the highs of that year in November. So corporate gave you a really good lead. Conversely, in the crisis, corporate credit spreads started to perform really well once the policy settings were changed in favour of the markets, but equities took until later on in early 2009 to start to perform. So investors can get a little bit of an edge by watching corporate credit. We certainly think that corporate credit is a dangerous allocation to have in conjunction with your equity portfolio at this point. Both of them could come along and hurt you, and you might not get that defensive characteristic that you're looking for at this point in the cycle. It's something that investors should give some consideration, certainly as we move forward into 2019, which is looking to be a much more challenging year, and ahead into 2020. You want to be early on this type of thing, you don't want to be late, because it's a very asymmetric repricing when it does happen. Pleasingly, the Jamieson Bonds active fund had nice positive returns again in November, up around 3.32% and on the way to around about a 3.5% return for the year. We've been running annualised returns since inception around about 4%, and they're all on a gross basis. So again, for AAA rated government assets with very high liquidity, a wonderful allocation for this point in the cycle. We believe we're doing a good job, and that's without anything really going too materially wrong yet. Obviously, this is a really critical asset allocation should things get trickier. One other thing that we should point out just prior to finishing, as much as we're making this video at the early stages of December, the US Treasury curve has now become flat to slightly inverted. You'll read about this more and more in the financial press as we go forward, but this curve inversion particularly between the yield of a 2-year bond and a 10-year bond, has preceded every US recession of the last 50 odd years, with one exception being 1967. It's happened again just now this week, in a shorter part of the curve, mind you, but it's certainly something investors should watch with great heightened awareness, as well as with corporate credit spreads going forward, to hopefully gain an edge and defend and protect their portfolios. Thank you.